Good morning. Thank you very much, Alan, for that introduction, and thank you, Harun, for that presentation. I am mindful of the time, so I will endeavor, I will not finish at 11, but we will try and make sure that I don't eat into your coffee break too much. All right, so IFRS 17 is a very important topic. Judging on the feedback that we've been getting from our members at the LIIA and within this audience as well. And I'm sure there are a lot of questions that you want to ask. Caveat. We will not be able to take or answer. We can take all your questions, but whether we will answer all your questions is no guarantee. So with an apology in advance, I would say that we have some questions that we have identified within this panel, which we think would be important for us to raise for your benefit. And the answers, I think, would help to address some of the questions that you might be thinking about or that you have posed. So I hope you don't mind if we go through some of those questions first, while the organizers arrange your questions accordingly. Or you can hold back your questions and listen to the answers coming forth, and then you could address them. Lastly, but definitely not the least, these three gentlemen here, we have an accountant, we have a regulator, and an actuary. So we have a very eminent panel here. You can definitely ask detailed questions throughout the day because these three gentlemen will be present for most of the day, and please do not hesitate to corner them and ask them your questions. And I'm sure they will politely answer them as best as they can. All right, without further ado, I would like to ask a couple of questions of Harun so that as a flow through to his presentation. And one of the questions that I would pose to him is pertaining to the scope and the applicability of IFRS 17 in general. And the question came to me in this manner. What are the key considerations for captives to determine whether they fall under the purview of IFRS 17? And how might this impact their financial reporting?
Yeah, thanks, Roy. My starting point is, if you are already IFRS 4 adopter, the general expectation is you will be fall under IFRS 17. The reason being, there's no significant change in terms of the definition of insurance contract between the two standards. If there's no significant change, then you shouldn't have a different outcome, unless the assessment was done previously, some mistakes and so on. So we don't want to go there. We will take it as good. The assessment was done properly under IFRS 4, and you are expected to comply with IFRS 17. That's what we see in most of the market. But if you are not non-insurer, then we do see some impact from old standard to new standard. Previously, they do not fall under IFRS 4, but when come IFRS 17, they are in scope. But that's more for non-insurer. Insurance company, captive, the expectation, as I said, need to apply IFRS 17. But what are the things that need to be looked at it from a technical perspective? Few things. Number one, the nature of the business being underwritten. Is it GI business? Is it a direct insurance? Is it a reinsurance? Is it a life business? Or is it a takaful business, and so on? So these are the things that we need to go through. That's number one. Number two, while I say just now, the expectation is if you apply IFRS 4 today, you expected to apply IFRS 17, it's good timing now for us to revisit and look at the assessment once more. The reason being, even though the expectation, the conclusion is not expected to change, but it's more to put forward the justification, the documentation that it meets the insurance risk under IFRS 17. A few things that we also can look at it to review the terms. Some of the captive is part of the group, some is a third party, some is affiliate, and so on. So then we can take this opportunity to revisit the assessment was done before, to conclude and to document down that the applicability. Okay? In terms of the impact, you asked about the impact. Okay? A few things. Some of the things we went through. In terms of the output, we saw the income statement going to change drastically. The balance sheet maybe not drastically, but the value going to change significantly. One of the things that I can think of is that because of the increased transparency introduced by IFRS 17, it's quite important, preparer of the financial statement for captive, to understand what are those so that we can be mindful. We don't want overnight, after IFRS 17 being published, more questions being posted. Things like there is a disclosure requirement. If the contract is a loss-making, we need to disclose the loss amount. If the contract is profitable, we need to disclose. We need to disclose a lot more risk management framework. We need to disclose a lot more detail about the cash flow, the money received, money paid out, and so on. So therefore, because of this increased transparency, some level of involvement is necessary. Okay? And the second part, I will say, in terms of impact to the financial reporting, is the profit recognition. While if you are a GI player, the profit recognition pattern is not expected to significantly differ compared to the current way of UPR method, unearned premium reserve method. But there could be some changes because of the application of time value of money, application of investment component, which is quite technical in nature. But there will be some impact on the top line. Bottom line, we also expect to see some impact, depends on the profitability of the contract issued. So these are the bare minimum things that need to look out for from the financial reporting purposes. Yeah.
Thank you very much. We have some questions from the floor, 2 questions on that. But before I look at it, I would like to ask a question from our actuary, Zainal, for the benefit of everybody here, is that perhaps you could explain the role of the actuary. Has it changed with IFRS 17 compared to IFRS 4, or is it the same? So if we could understand the role of the actuary in regards to IFRS 17.
Thank you for that question. Okay, pre-IFRS 17 and post-IFRS 17. Basically, before IFRS 17, you have IFRS 4, and under IFRS 4, the actuary works independently of the accountants. Basically, the accountants is in one room, actuary is in another room. They do the calculations, and then basically they just put the figures together. Okay. The actuary, of course, does look at accounts, because one of the things that's very important when the actuary does his work is to ensure that there is correspondence between the data that he uses for the purpose of doing his actual valuation and basically the data that's used for the purpose of the accounts. So he does use the accounts for that checking purposes. But other than that, he basically does his work independently. So this is very important because he's not bound by any guidance from the accounting profession. All right. What actually does, he is tasked with a job of actually putting a figure in terms of the contingent liability that the insurance company will face. Contingent being that, effectively you have made a promise that you're going to pay a benefit on the occurrence of a particular event. So there's a promise. It's not something that you can actually hold or feel. It's a promise in the future. So we have to actually put a figure on that promise. Right? And effectively as well, the actuary also does this computation called IBNR, incurred but not reported claims, whereby he looks in terms of the claims that has incurred but has not yet been paid. Now, how much ultimately will the insurance company be paying out in terms of these claims? So he does his calculations, he comes up with a figure for what is the liability in respect of future claims, what's the liability in fact of incurred claims, and this goes into the balance sheet. Okay, and then given that these figures are calculated at the end of the year, and you have we call the corresponding figures at the beginning of the year, the accounts for the prior year, then you have this change in reserve, and those change in reserves are the one that actually determines the profit for the year, right? So this is done independently. I'll talk a bit more in terms of how the methodology and the basis are determined by the actuary, a bit later. Okay. Now this changes IFRS 17. Suddenly the actual profession, the accounting profession woke up to the fact that, well, they knew about this already, because that's why it took them a long time to come up with IFRS 17. Okay. Actual profession, the accounting profession realized that, these actuaries, they go in their room, they do the calculations, they come up with these figures. I mean, who's to say that, actuary company A and actuary company B and actuary company C would be using the same methodologies, consistent assumptions in coming up, with the technical reserves in the balance sheet, right? Now that poses a problem, because if different actuaries are using different methodology, different assumptions, then the profits that's actually reported by the insurance company basically will not be comparable between one company A, company B, and company C. So this is a big problem, and that's the reason I would then say that why IFRS 17 is so complicated, because the calculation that the actuary does in coming up with figures for long-term contracts, I have to say, is not easy. So post IFRS 17, the actuary now has got the look in terms of what the IFRS 17 says about the methodology to be used, how the assumptions are determined, all right, and effectively also refer to the client, because the IFRS 17 is principles-based. There are options in terms of how, what method you can use for the purpose of valuation. There are options in terms, for example, the profit carrier. What profit carrier can be used for long-term contracts. So this is something quite different than what it was before. It's a change in terms of how the actuary works. And going forward, at least for the direct companies, it's likely that the actuarial department and the finance department, to some extent, will have to actually work closer together, maybe even merge. So this is something which it is quite different if you compare it to what it was in IFRS 4.
Thank you, Zainal. I will have to pose a question to our regulator representative, Syahrul. And there's one particular question that comes to our attention here, is that, with the wide-ranging impact of IFRS 17 on the international insurance landscape, and it applies indiscriminately to even captive insurance, I think we are very interested to know what is Labuan FSA's stance or expectation with regards to IFRS 17.
Thank you, Roy. I think before I start, I would have to say I'm a bit disadvantaged compared to the experts in the house at the moment. One thing is because I'm a non-practicing accountant and also an unqualified actuary, despite having both backgrounds. But I suppose that's a good thing, because any technical questions can easily be posed to my esteemed colleagues in the panel. The other part is, of course, my current eye condition. So I suppose the good thing is that I can answer half of the questions that is posed to me. Right? 50% discount, yeah, Roy? Okay. So from the Labuan IBFC point of view, as you know, we try to conform to the very best of the international standards out there, be in the realm of taxation, AML, CFT, prudential regulations, and in this case, accounting standards. So we welcome those kind of developments. And again, we need to understand as well in terms of the changes made by the standards. Any changes made to a particular standard is because to close the deficiencies seen in the previous requirements, to make them more modernized and make them more relevant. And hence, the same thing is happening for IFRS 17. So we look and see in how it was applied under IFRS 4. There are some gaps that's apparent. And one of the, I think few things were already highlighted by Harun earlier on and Cik Zainal. Some of the things I can pick out, for example, in terms of the providing stability into the financial statements. the profit recognition that is streamlined with the IFRS 15 revenue recognition, and it needs to be corresponding to the services that is provided throughout the duration of the contract. So that's a more prudent way of profit recognition. And again, if there is actually a loss making profit, then that should be recognized in day one. It's a prudent approach. Secondly, in terms of providing clear elements of contract within the income recognition itself. And previously, there's a single item called premiums, but nobody knows what is the building blocks to that. And this is one attempt of IFRS 17 to flesh out what are the different components of obligation and put that as a component of revenue to be recognized, be it best estimate, risk adjusted, or even the profit margin part, the CSM, contractual service margin. So again, I'm talking about the new changes of approach, which Harun touched about in terms of the general methods. Yeah? The premium approach, premium allocation approach is something else which has already been preserved. It's not going to be changed. The other part which I think quite interesting in terms of IFRS 17 was that it tries to streamline the valuation measurement for insurance liabilities vis-a-vis that of the investment assets, the financial instruments. So that brings greater correlation in terms of movement between the two sides of the balance sheet. That's something which is quite unique, and IFRS 4 does not have that. In terms of relevancy, you mentioned whether it's relevant for captive to adopt it. Yes, of course. Because for captives in Labuan, for instance, they are expected to carry out insurance business just like a normal insurer, a commercial insurer. And having said that, there are some limitations to how we apply the particular requirements between captives and also the commercial insurers. As we know, captives is also a private setup. It has a set of related companies as its insureds, which is different compared to a normal insurer with the public. So in that sense, we come from, FSA always try to adopt a fit-for-purpose requirements. And in this case, we allow greater flexibility for captives and insurers to adopt either the MIFRS, International IFRS, UK GAAP, US GAAP, and for captives specifically, even SME accounting, like Malaysian PERS. So that is something we acknowledge that we need to give flexibility for captives to adopt so that they can have a right kind of IFRS that suits their smaller setup. I think that's about it.
Okay. Thank you, thank you. Well, I'm going to look at some of the questions from the Slido here that I've got. And one very interesting question here, which I'm sure is a burning question. And if I could read it, and thank you, Adrian, whoever you are, for the question. No doubt IFRS 17 should result in additional audit work. What will be the reasonable range of increase in audit fees that we can expect? And I'm sure Harun's response will be obvious.
Yes, it will be definitely obvious. Okay, it's only the upside. Okay, but I would say it depends on the type of business. If you are a GI player and the company only use simplified approach to measure the liability under IFRS 17, the expectation of the increase is not substantial. Okay, maybe I just put some hypothetical range. Can be 1.2 times of existing fees, about there. But if you are life insurers, or even for GI player, apply GMM model and so on, especially life, maybe we just put life. But I would say this increase could be substantial. The reason why we say substantial, because at least in Malaysia context, we have dual reporting. One reporting using IFRS 17 framework for submission to our SSM, the regulator, on the statutory purposes. But at the same time, our central bank, Bank Negara Malaysia, still require a submission using IFRS 4. Because of this dual reporting, that's the reason why I say it's increasing. If eventually the current plan from Bank Negara is that in 2025, they will drop off IFRS 4, there's going to be only one reporting. At that particular point in time, there could be some reduction back, may not be existing level, okay? But at the interim stage, year 2023, year 2024, there will be increase. But whether is it going to be 1.5 times, 1.6 times of existing fees, is again depends on the type of the contract issued. I'll give you an example. I have one insurer, only life insurer, only writing non-participating business. They don't have par business, they don't have universal life and so on. Very straightforward. For those companies versus another company where they have everything under the sky. Okay, annuity, universal life, also got Takafu windows and so on. So obviously, the impact of so-called this dual reporting is much more, and the effort required is much more. So I would say it will range. Depends on the type of insurance. Yeah.
Okay, thank you. Would it be safe to say that the actuarial fees will make no difference in this rule? You don't have to answer that question, Zainal. I'm being cheeky. I'm being cheeky here. I mean, to Zainal, there's a question which I think you shared with me, and I think you were talking about currently under IFRS 4, the same balance sheet is used for regulatory solvency computation. Now, do you expect there will be a need to prepare two balance sheets post IFRS 17?
Yeah, this is the million-dollar question. I mean, initially, when IFRS 17 was being formulated, I think Bank Negara had aspirations that effectively, just like under IFRS 4, that eventually under IFRS 17, there will only be one balance sheet, both for the purpose of financial reporting and regulatory reporting. But I think now the realization is that that might not be possible. I think we need to actually understand why it will not be possible. Then first of all is that regulatory reporting is for the purpose of determining solvency. What do I mean by solvency? Right? You are actually an insurance company, you made a promise that you pay someone, the entity that is insured with you, should an event happen, you will actually compensate him or it for the claim that's occurred. Okay? Now, it's a promise, and you receive the premium in advance. So there is this possibility that you will not be around when claim does occur. And that's why regulators around the world basically imposes some kind of requirement for solvency, how much capital you have got to hold. And that solvency computation has actually evolved over the years to become more and more complicated, more risk-based. Initially, it was not so much risk-based. I mean, what you currently have, in terms of computation for solvency for captives, for example, in LOFSA, is pretty basic. I would say that's Solvency 0, right? There's Solvency 0, Solvency 1, and Solvency 2 in the UK, in Europe, what we call here RBC, risk-based capital, right? So the purpose is different, because it's for the purpose of solvency. You look at risks, you look at market risk, you look at credit risk, you look at, and of course, the insurance risk, and then you have this requirement to be at 75th percentile, then you have the requirement at 99.5 percentile, okay? And when it comes to from 75th percentile to 99.5 percentile, you have this thing called CAR ratio, all right, which is basically how much additional capital you've got to hold to actually ensure that only you were able to pay claims in 199 or 200 years, for example, to the extent that that is possible to compute, as it were. Now, for the purpose of another thing as well is that the fact is that when you introduce regulatory reporting, solvency reporting, you want to ensure that you can able to actually benchmark all the insurance companies' solvency. Because you don't want to impose a solvency basis whereby suddenly overnight all companies are insolvent. That can be possible if your solvency basis is very, very strict, as it were. So you have this benchmarking as well. Financial reporting, you're not just looking at the balance sheet. I mentioned just now that currently IFRS 4, the reserves that the actuary puts in place will impact in terms of profit emerging in the year, because you look at the change in the reserves at the beginning of the year and change the reserve at the end of the year. Actuaries basically are we're looking at, we're actually accountants in a way, but we're looking at prospectively, all right? We've always been looking at prospectively, basically. Now, Now, of course, the accounts under IFRS 17 will also be looking prospectively, but the accounts under IFRS 17 are also very particular in terms of how you present your financial statement, your profit and loss statement. Actuaries in the past have never been concerned about that. We're just looking at solvency at any point of time, balance sheet, balance sheet, balance sheet. Right? So under IFRS 17, you're concerned about how much profits is actually should be recognized in the year, how much profits basically you have already can expect from the existing block of business. This is for a long-term contract, right? So they're not concerned about solvency, right? They don't really care about solvency. That does mean, though, that even though you declare profit for the year, it does not mean you can distribute that profit. You can only distribute the profit if you're solvent, right? So profit is yes, you declare it. It's something which is important for the shareholders, but payment of the profits is dependent on the regulator, all right? In terms of whether they feel that you're solvent, you can pay your liability, you can pay basically your obligations. So that's important. So in a way, dividends that you pay is not from profits. Dividends that you pay is from your balance sheet, from your retained earnings, all right? And the regulator will determine, how much of your retained earnings is required for solvency purposes. All right? So I don't think that there will be two, or there'll be basically one balance sheet, right? There will have to be two balance sheets. So unfortunately, it will involve more work. But for captives, it's a bit of a different animal, which perhaps later I can just elaborate a bit more in terms of that. Thank you.
Okay, we have just about 9 minutes left. So I've got two questions for the regulator, Syahrul, but I'll come to you later as I want to have some quick fire questions here. And I think this is largely within the purview of our accountant, Harun. And I'll deal with the point that's just recently came up. What are the major challenges encountered by companies who already adopted IFRS 17?
Yeah. So for those people that already spend much more effort earlier stage of the project, I would say they are in a good hand. They're able to generate the result, and they're happily reporting the result for the last 2 quarters already. Last month was the announcement and publication of the second quarter result, so all's good. But some players are still struggling, some fine-tuning, some adjustment to the opening balance, and then rerun again and try to optimize the result and so on. But there are some players still struggling. Okay, so if you ask me the lesson learned, there was a lot of lesson learned challenges at the early stage of the project. Myself, Encik Zainal, also we are heavily involved in and good discussion in terms of the technical aspect, technical interpretation, but that's already passed. Now what we do see for those players that struggling is very much more on the data quality, underestimation of the data mapping exercise, the testing and so on. So I would say, while the person asked this question, not sure whether you're already IFRS 17 adopter or not yet, but we are in the month of September, we should be tapering down. For those late adopter, so these are the lessons learned can be taken into account so that we don't repeat or minimize some of the challenges being faced in the implementation. Yeah.
Okay, thanks for that. Now, there's a question pertaining to traditional captives versus takaful captives. And the question is, I think this is across to the panel, but I think Harun, if you could take this question first, and then we'll ask the comments from the panel. What is the difference between IFRS for a traditional captive versus a takaful captive in Labuan?
Yeah, so let me start, then maybe Zainal can add on. Yeah, so we also have this, when the standard was issued in 2017, there's a lot of long debates, discussion that we have, many parties involved, where to evaluate whether is takaful, we need to apply IFRS 17 or not. So we went through a journey, and then in Malaysia, the good news is that there are some bulletin issued by MASB to give some certainty to the market about the application of IFRS 17 to takaful. But the uniqueness of takaful is that we have a multiple element. We have the operator fund, we have the risk fund, the investment fund, and the company. So the application, there are some different technical considerations that we need to include. But on the overall perspective, IFRS 17 is being applied at least in Malaysia. Of course, I know some other market, Middle East, Brunei, being applied IFRS 17 for takaful. So I would say short answer for that particular question is the application of IFRS 17 is the same. The content used is the same. Of course, because of the uniqueness of takaful, there are certain elements of the takaful cash flow that we need to have a different consideration in terms of each application. Contractual service margin, the risk adjustment, the acquisition cost. There will be unique because of the substance of the takaful structure. But other than that, the baseline requirement is similar between conventional insurer and takaful operator. Maybe Encik Zainal want to add on the takaful. Yeah.
Thank you. I'm running battle with Harun on this one. I don't agree what he says in terms of takaful, percentage takaful. Anyway, that's not what we're going to discuss today. Now, I think I will actually basically sort of collapse that question to, one of the questions I've sort of asked me perhaps that, I could actually expand on. And that is, to what extent is that, IFRS 17 should apply for captives. Right, this is my personal view, but effectively, we're in a discussion, so maybe it's good to actually discuss this. Let's just consider, for example, because this is relevant to takaful. That's why I'm not trying to avoid the question here. This is relevant to takaful. Let's assume that you got a single parent captive, right? Single parent captive. Let's assume that you do not have a fronting arrangement, no fronting arrangement, because the Bank Negara has allowed you to go straight to the captive without going through a fronting arrangement. Okay, so in respect of this captive, effectively, you then say, okay, does it have an insurance contract, right? Because there's only one policy holder, and that policy holder is the parent. And under section paragraph, what is this? B27C, when you have self-insurance, IFRS 17 does not apply. Okay? So, no need to apply IFRS 17. Now, look at the parent's position, basically. The parent's position, basically, is that, you have to consolidate the accounts. So it falls down to the parent. Again, effectively, you are doing self-insurance, except that now you're doing it, within yourself. You didn't have to have, like, morph into a captive, and then, then you have, because you have to remember, most captives, the parent is not an insurance company. And that's one problem as well in terms of captives applying IFRS 17, because, if your parent is an insurance company, you've got the systems there. You know what to do. The data you provide to your captive is ready in a position whereby you can apply IFRS 17. But usually, for captives, your parent is not an insurance company. So having to actually do the accounting as an insurance company can involve a lot of work, a lot of effort, a lot of costs, basically. But going back to what I said just now, you consolidate it into the accounts, everything disappears because you're consolidating a wholly owned company with your business. You actually disappears. The only issue there is your reinsurance contract held at the level of the captive level, all right? Because your captive will not retain all the risks. You will reinsure the risks outwards. So when you consolidate it, if you like, or even when you consolidate it, then this reinsurance contract held. I guess you can also look at it from the perspective of the captive. What is reinsurance? Reinsurance is insurance of an insurance company, right? So it's definition, that's the definition. Now, if you are actually self-insuring and then you buy insurance from a reinsurance company, is that reinsurance or is that insurance, is it? Terminology, is it? Because if it's not reinsurance held, then again, you don't have to apply IFRS 17, is it? Right? So the view I have here is that, if you're a single parent captive, basically, no fronting, then effectively you basically, you don't have to apply IFRS 17. Now, in terms of fronting, yes, once you do fronting, then effectively, the captive is basically doing insurance because you have a contract between the captive and the fronting company. But when you consolidate, what happens just now happens again here, no problem with it. Okay? So when you basically do fronting, you have an insurance contract, and therefore, you have to apply a basis of actually accounting for that. Of course, no, you don't have to apply IFRS 17. You don't have to apply IFRS because the regulator in Labuan allows you to apply other standards as well. It's interesting to note that the UK is not applying IFRS 17. They're not going to actually apply IFRS 17, not at this point in time anyway. Europe will, all right, but UK, because they're out of the union, is basically not. So when you go to Takaful, same thing applies. You are the operator, you are the insured risk, you go and consolidate, nothing happens. Up there as well, I mean, when you talk about Takaful operator, captive, what are you talking about? You are the operator, you use your risk, basically. The definition is going to be a bit more sort of, need to be refined. I think time is up, so I'll stop at that. You can catch me later on to discuss that. Harun, maybe I have to give you the last word on that one.
Even though it says time up here, I said I won't finish on time. So we will finish in about 5 minutes. So please bear with us. Syahrul.
Yeah, right, sorry. Okay, just to echo some of my colleagues in terms of my panelists, fellow panelists. I do agree that the IFRS is, although relevant as an insurance sector as a whole, but for captives, and particularly for Labuan, the impact of it would be much, much lesser. As I said, we don't adopt a singular accounting regime. So in that sense, the flexibility is there for the captive operator to choose FRS of their choice. One would also need to see in terms of the businesses which can be impacted. So looking through the captive premiums as a sector, I would say about 90% or more of those businesses are actually general. And then a portion of it, a small portion is re, and the rest are direct. So in that sense, the impact of which that FRS may have, even if they were to adopt it, can be minimal in terms of the state phase of the accounts. But in terms of the investments made in order to make ready those systems, to prepare them in accordance to the items specified, that could be some compliance cost. But I would say it's a fixed cost because it's a one-off during transitory year, this year. The other portion I think want to appreciate, Zainal mentioned the right things about the single parent captives. In those sense, maybe there's no need for us to have a transparent FRS or transparent looking FRS. But captives in Labuan also allows for different structures. We have the PCC, protective cell companies. So in that sense, the segmental reporting within those structures may require some transparency, especially if these cells are rented out to third parties. So they should be able to access the latest financial and the most transparent available with regard to how the business are run by the PCC in Labuan. So there's a bit of difference there. Yeah.
Okay, cool. I mean, just to round off the point, Syahrul, I would be curious to know what is Labuan FSA's in immediate or long-term plans to facilitate the market's adoption of IFRS 17, and where do you see LFSA taking this?
Right. From our perspective, I think the main sectors that require a bit of management in terms of how they actually adopt IFRS 17 would be the insurers, before I touch on captives. So in this regard, FSA actually had rolled out its solvency. It's not solvency 0.0, yeah, Zainal? It is actually a hybrid between what Bank Negara has and also those good practices from Singapore, Hong Kong, and also EU Solvency II, where we can and put together into the hybrid solvency model. So I would say it's Solvency 1.5, okay? And for these entities, insurers which are applying RBC or Insurance Capital Adequacy Framework, ICAF, they are already halfway into the IFRS 17 regime. It's just a matter of them perhaps to reconcile between the items used in the accounting and then with that which is supposed to be submitted to FSA. So that's a bit of a teething period. The only part for captives, these are not subjected to the RBC rigors because we felt that through the benchmarking, margin of solvency is good enough for us to actually regulate the captives. Nonetheless, we actually make use of other models like in Guernsey, capital models in Guernsey, where they still use margin of solvency as one of their solvency yardstick. and then have that to include all the key elements that is needed to come out something akin to what the international standard under the IAIS requires for captive regulation and supervision. So we have that. But what we find IFRS 17 is quite unique is that it tries to also gel in RBC elements into the way that the reporting entity is supposed to have. So presumably, captive does not apply RBC, but rather if it is actually already into adopting IFRS, they're already halfway into RBC environment. So this is a very good practice. It's in a way to make sure they are prudently operating and similar, if not akin to what we expect normal insurer is supposed to operate in. In terms of going forward, I'm getting back to that question. We are working closely with the LIIA, especially the actuaries within the industry, to see the impact of the ICAF in terms of business operation, including concurrent developments like has been seen in IFRS 17. So if there are any areas which we see as also relevant for captives, we definitely will reach out and provide guidance to the captive players as well. The second portion, we talk about bank negaras harmonizing their requirements, especially for regulatory reporting. We are working closely with bank negara as well, because most of our regulatory reporting is similar. So in that sense, whatever milestones achieved by the central bank, we would definitely try to adopt it to, for Labuan's market purpose. And the third portion, we've heard about, DG mentioned about we having a cooperation with Bermuda. As you know, Bermuda is the largest captive market. They've already got into all these developments, IFRS 17, 2-3 years ago. So we try to reap some kind of importation of good practices from there. Where they are relevant, then we will try to see whether this can be emulated for Labuan purposes.
Okay, thank you, Syahrul. With that, we come to an end, but I'm just going to quickly go through the 3 questions here. We're not going to answer it, but I'm sure that the people who presented, or the persons who presented this, will approach them, the panelists, for some answers. One was the cost of compliance is increasing, and what is the expected actual costs for implementing IFRS for a general insurance captive, and do they need to buy software? Whoever asked that question, I think you can approach Zainal. Don't answer it, Zainal, yet, but I hope they would approach you. The other question, I think by Adrian Chua, was not all domiciles are adopting IFRS 17 due to options to stick to local GAAP. What will your view be in terms of impact on the level playing field? And I think these 3 gentlemen can easily answer that, but from their various perspectives. So I asked Adrian if you could approach them. The other point is, of course, for direct acquisition experience. There's so much of shorthand here, I'm having great difficulty to read it. Yes, maybe you could.
For direct acquisition expenses, you will defer the amount based on the premium policy, but the experience or expenses haven't paid yet. So why we are recognizing it as a deferred expenses instead of accrual expenses? This is very technical. So
very technical, yes. So the person who asked this question, please approach Harun later. Ladies and gentlemen, on that happy note, we have come to an end to this. I would like to thank the panelists for answering the questions. I would like to thank the audience for raising your questions. I do apologize that we could not answer all of it, but I urge you to approach these gentlemen later at the break and throughout the day and try and put forth your questions to them directly, because this is an important topic. On that note, I pass the floor to Alan.